Hi, this is Matt with Gray Matter Trading, and today we're going to be looking at the exponential moving average, or EMA. The EMA is a moving average that, opposed to the SMA, does not give equal value to all price levels, but instead places greater weight on the most recent prices when doing the calculation. For anyone that may be interested, here's the formula used to find the EMA value, but just like any other indicator, you don't really need to know this because your trading platform should calculate this for you, although understanding the math behind it may help in utilizing it in your trading. Like the SMA, the EMA is used to point out trends and to signal entry and exit points, although because the EMA places greater weight on the most recent price points, it's much more reactive to the changes in prices. So although it's useful in any time period, short-term traders are the ones that typically pay most attention to it because of its quick reactions. A couple important things to note when you're using moving average trading strategies is, first of all, the rate of change. So if you're seeing the moving average climbing and all of a sudden it looks like it's starting to round out like the top of a hill, it's likely to indicate a pullback. Secondly, and we'll be looking at an example of this in a second, is the distance of the current price from the moving average. Now, trading strategies using the EMA will be very similar to the ones using the SMA because they're both moving averages, and these are moving average trading strategies, not specifically EMA or SMA strategies. The first one we're going to be looking at is moving average crosses. The first one is the golden cross, where the short-term moving average crosses above the long-term moving average, which would be a bullish signal. And the inverse of that would be called the death cross, where the short-term moving averages crosses below the long-term average, which would of course be a bearish signal. The next way that you can apply this is to use the EMA to identify trends. Basically, when the price level crosses below the moving average, the stock is in a downtrend and you treat the moving average as a resistance level. When the price level crosses above the moving average, the stock is in an uptrend and you treat the moving average as a support. And the last strategy that we're going to be talking about is using moving averages as stop losses and profit targets. Say you've entered a position long and the price broke above the EMA. A common strategy would be to hold until the price breaks back below the EMA. As for a profit target in this example, you could use another moving average, another technical indicator, Fibonacci retracement, or the nearest whole dollar, 50 cent, or 25 cent marks, because those are all psychological support and resistance levels. All right, so here we're looking at Snapchat on the 5-minute chart. I've highlighted here an example of a moving average trend strategy. As soon as the price breaks above this EMA, that's an indication of a bullish trend. The price continues to climb and climb, testing the moving average here, and here. And as soon as it crosses back below this moving average, it's followed by a sharp drop in the price. Here's an example of a death cross and a golden cross on ticker symbol RAD on the 4-hour chart, and something important to pay attention to for both of these examples is the distance of the price from the moving average. First, there's this death cross, which is immediately followed by a dramatic drop in the price. If you were to take a short position at this point and hold until the next break above the EMA, you would have had a pretty profitable trade, but you can see that the price is very far away from this moving average. If you were to wait until the pullback and enter once the price begins to move off of this EMA again, you'd have had another 20-ish cents per share, making that a much more profitable trade. And here again, we have a moving average cross followed by a significant price movement, followed by a significant pullback and a continuation of the trend until the price crosses back over this moving average. So there's kind of the basics of the exponential moving average. Let me know in comments what other topics you'd like to have covered in future videos, and feel free to subscribe and follow Gray Matter Trading on social media. Thanks for watching.